YouTube and Facebook. This is Paul, the Death Scouter, making another video for my Death Scouter YouTube channel. Like and subscribe. I promise you'll find great content, especially for those of you who are starting your investment journey and you want to know how do I start to speak investing. So there's three things that we do with money. We spend it, we save it, we earn it. The difference between saving and investing, because we're not going to talk about spending, is that savings protects what you have. It takes the money you already have and keeps it safe, like putting it into a piggy bank or driving it down the street and depositing it into a brick and mortar bank. It is for money that you need in relatively short amount of time, 3 to 5 years, where you can't risk the ups and downs of the stock market. And it is a perfect place to put your emergency fund or any sinking funds. What is a sinking fund? If you're a car owner, there's going to be a day you need new tires. You should save up today for new tires. That's what a sinking fund is for. And when you buy those tires, that fund sinks all the way down to zero, and that's perfectly fine because that's what that account was made for. So sinking funds, emergency funds, money you need in less than 5 years is money that we save and protect. But everything else, we're going to go ahead and try to earn more money with it. That is investing. Investing generally comes with some level of risk, and the systems that we use for investing our money typically break down into stocks and bonds, real estate, or even a business venture. Now, there's a quick word about risk and reward. Typically, the more risky something is, the greater the rewards, right? Otherwise, why would you do it? But keep in mind that with risk comes the chance of losses. You can't be bedazzled by only seeing the big gains. You have to realize that big gains are usually offset by big losses. But when it comes to discussing risk in the investment world, the word of the day is beta. So a beta of 1 indicates that the investment is just as risky as the rest of the stock market as measured by the S&P 500. If you happen to find something that has a beta lower than 1, then it is safer in general than the stock market. And are there ever stocks that are like that? Well, certainly are. Here's McDonald's, for example. And when we look at the investors information sheet for McDonald's, we see that it has a beta less than 1. So in general, McDonald's is one of those companies that's safer than the stock market in general. For us, we are going to focus on investing through stocks and bonds and a combination of such in funds. So stock is ownership in a company. A bond is when you loan money to either a company or to the government. And when you make a loan, they promise to pay you back at a certain interest rate, which means you know exactly what you're going to get, how much you're going to get. It's safer, it's predictable, and therefore, based on risk versus reward, bonds tend to have a lower return in exchange for the higher safety or lower risk. But stocks tend to be a little riskier, and such they have higher returns. So what is the stock market? Where do you even go to buy a stock? How does all this stuff even work? And where is it all happening? Well, it's mostly happening up in the financial district of New York. Other countries like Tokyo has their own exchange. Other countries have their own stock market with their own exchanges. Ours is located up in New York. It is overseen by the Securities and Exchange Commission, and it is literally just like going to the supermarket. Except in this supermarket, we're not buying products, we're buying the companies that make the products. And you, as an investor, can open up a brokerage account, and your brokerage account is nothing more than an empty shopping cart. This is where a lot of people start getting confused. They say, oh, is an IRA a good investment? Well, your IRA is just a shopping cart. Is my brokerage account a good investment? Well, your brokerage account is just an empty shopping cart. You have to pick the investments and put them into the basket in order for you to know what you're investing in. So a brokerage account simply holds whatever you want to put your investments in. They can be found at a number of brokerage firms. And the idea behind these carts is you can have certain carts for certain purposes. Individual retirement accounts, taxable brokerage accounts, or even a money market account. How you use these carts will determine how the IRS treats you come tax time. So let's talk about how money flows when you want to become an investor. Well, you start with your either savings account or checking account, and you call in a brokerage firm and you open up an account with the brokerage firm, and they will immediately create for you their own money market account. Okay, then you will establish through wire transfers and trusted relationships a way to wire money back and forth. Now, if you transfer money to your brokerage firm, it will land in your money market account. And yes, that money market account is just like a savings account. It pays interest just like money in the bank. So at this point, all you really did was take money out of your left pocket, put it into your right pocket. But also at the brokerage firm, you can open up different accounts, such as a taxable trading account or an IRA, an account you'll use for retirement. And again, these are just shopping carts. How you pick investments to go into these shopping carts is when you order a buy transaction using the money that's sitting in your money market account. So you can buy and sell within the brokerage firm into your money market account or into your brokerage accounts. And remember that these accounts are just shopping carts. You still have to pick the investments that are going to go into them. So let's talk about why there are different types of accounts. You don't just open up an account and go, oh, this is the one that I'll use for retirement. When you designate something as retirement money, it gets very special, aka preferred treatment from the IRS. Individual retirement accounts have a couple of different flavors. You have the traditional or pre-tax IRA, individual retirement account. You have the Roth plan, you have a self-employment pension IRA, or you can even, if you're self-employed and have no employees, you can even open up your own solo 401k plan. And in any of these plans, you're going to be treated with very good tax rules and tax savings because the government wants you to plan for retirement. In the pre-tax traditional account, let's talk about how that works. This is where you pay no income tax on the money today, but you will pay income tax when you withdraw the money in the future. So let's take a look at the three components here. You have your paycheck, you have your IRA account at your brokerage firm, and at the end of the year, you're going to file your tax forms. If you earn $50,000 in salary, and you put $7,000 in to a traditional IRA or a pre-tax IRA, also known as a tax deferred IRA, like how many names can we give to the same thing? What happens at the end of the year is you subtract the money that you put into retirement from your salary. So you will be taxed at the end of the year as if you earned less money. You are skipping or deferring the taxes today that you would have ordinarily paid. And now in the future, age 59 and a half, when you make a withdrawal from retirement, it will be counted as income and you simply file your taxes again, and whatever money that you withdrew, then you'll pay your income taxes. So we're always paying income tax. You either pay me today or you pay me tomorrow, but you're going to pay. So with a traditional IRA, you're paying your taxes later only on the money that you withdraw. The Roth plan is a little different. You can fund the Roth plan with the money that you have in your pocket today, with the promise that when you withdraw it in the future, you pay nothing. So let's bring those graphics up again. So you get your $50,000 salary. You put $7,000 into your IRA contribution. You still owe taxes on your $50,000 salary. You saw no tax savings. You saw no tax deferral today. Okay, so when do you see your benefit for taxes? When you retire or pass age 59 and a half, the money that you pull out of your Roth plan is 100% income tax free. You paid your taxes on the front end, it grew to a monster, and then you have no taxes on the back end. And for this reason alone, Roth plans are very popular. So what are the rules for retirement plans? Well, with a traditional plan, if you touch your money before age 59 and a half, you will owe a 10% penalty for touching retirement money early. You'll pay income taxes on any money you withdraw. Remember, you didn't pay taxes on it yet, so you'll pay your taxes when you do your withdrawal. There are some exceptions for avoiding the 10% early withdrawal penalty, but there is never a way to withdraw your money without paying income tax. Now, I've put the rest of the bulleted items in different colors so you know that they mean something else. There is something called a required minimum distribution. So you could put money into a retirement plan and let it grow to some phenomenal numbers. But the government says that starting at age 73, you must start making withdrawals. And if you don't, they will put a 25% excise tax on the money that you should have withdrawn but didn't. So there's definitely want to make sure that you're making your withdrawals when you're supposed to. And for estate planning purposes, if you pass away and someone inherits a traditional or tax deferred or IRA account, they also must take the minimum required distributions and liquidate it within 10 years. The rules for the Roth plan are slightly different. Remember that we've already paid taxes on the money that we put in. So what rules apply for Roth? So a 10% penalty and income taxes does apply if you make an early withdrawal and if you withdraw any money prior to the account being 5 years old. Once it's past 5 years, some different rules apply. Your contributions, which you already pay taxes on, can be withdrawn without taxes, without penalty after 5 years. Any growth or appreciation that you've had in the account, you can't touch until age 59, or you're subjected to the same 10% and income tax penalties as the other account. The nice thing is, there are no required minimum distributions on a Roth plan, but if someone inherits your Roth plan, they too are subject to the 10-year rule where it has to be liquidated within 10 years. But again, they're going to get this money all tax-free anyway, so they could simply pull the money out and roll it into a different account for themselves. And if it's not retirement money, then what is it? Well, then it's a taxable brokerage account. So here, this is just where you buy your stocks, bonds, other securities that are not meant for retirement. Again, they're going to be taxed differently than retirement and differently than your ordinary income in most cases. So when you buy something and you sell it for a profit, that is called a gain, and you will pay what is called a capital gains tax, which is significantly lower than if you were just earning more money in your paycheck. You can also sell something at a loss. If you sell it and the day that you sold it, it was worth less than you bought it for, and sometimes you want to do that and get rid of stocks that aren't performing well. The nice thing is, even though you've taken a loss, you can use that loss to offset other income or other capital gains. So in a way, the government is telling you, if you play the investment game, You'll never lose money. We will always help you get at least back to zero. We will let your losses offset other income and help you get back to zero. They want us to be investing. And if you do happen to sell something for a profit, the question then becomes, did you own it for more than a year or less than a year? Short-term capital gains simply get added to your income and you're taxed at your regular income level. But anything that you've held for more than 1 year is subject to a long-term capital gains rate, and based upon your income may be as little as 0% tax or only 15% tax compared to what is probably 30% in your regular ordinary income, the tax rates that you pay against your paycheck. So there is a couple different philosophies for investing: growth-oriented investing and income-oriented investing. Growth is when we see an appreciation in the share price. So you buy something for $100, it goes up to $200. That is a growth investment. An income investment means you don't really expect the price to grow that much. Now, there's companies that are very well established, but they're not growing anymore. But they remain incredibly profitable, and they share those profits with you in the form of a dividend. And those are the companies that many will refer to as a dividend or an investment property or an income equity or income share. So many different terms for the same thing, but the concept is the same. So let's take a look at this for a second. Here's a stock chart for a company named NVIDIA. They make graphical processing cards for computers. They have seen tremendous growth in stock price. This is definitely a growth stock. As silly as it sounds, they do pay a 1 cent per share dividend, but I don't think anybody would invest in NVIDIA looking for dividend gains. They are looking for share price appreciation. The day may come when NVIDIA saturates the market and may keep people interested with sharing profits through dividends, but today they are a growth stock. Compare that to what is some would call the blue chip or an income stock. Blue chip meaning the most expensive poker chip on the table. These are companies that have been around forever and they have saturated the market. They're not really growing anymore. This one happens to be ExxonMobil Oil Company. They're not really growing anymore, but they continue to sell billions of barrels every day of highly profitable crude oil. So they share their profits with their stockholders, and they do that in the form of a dividend. Now, dividend investing gets a little weird, and we're not going to go too deep into it, but understand two different terms when it comes to dividend investing. There is the dividend itself, which is paid on a per share basis. So in this particular example, ExxonMobil pays 99 cents per quarter. So basically $3.96 a year per share. Regardless of what the share price does, you receive 99 cents a quarter for each share that you own. Okay, that is the dividend. But people will make a correlation between that $3.96 dividend and the share price, and it becomes a fraction. Dividend on the top, share price on the bottom. If the share price goes down, because the dividend doesn't change, but the share lost value, the share price went down, it changes the math, and what people call the dividend yield will therefore change. So today, at the current price of $107.71 a share, the dividend yield for Exxon is 3.68%. Just don't make the mistake in thinking that whatever the share price changes to, you'll get 3.68% of that number. If that share price crashes, that dividend yield is going to go up through the roof. And before you get excited about a 15 or 20% dividend yield, keep in mind that if you already bought this stock, you probably took a bath in the stock price going down. So dividend yield is a very, very high level indicator of what a stock is doing. But the dividend price, or the dividend, a steady stock price, and the ability for a company to continue to pay a dividend year after year after year are some of the nuances that you look for in dividend investing. I had to explain all of that so that you understood what all these terms are. Remember, this video is about the terms, not really teaching you how to invest. So folks, those are the terms that I thought were necessary for you to start speaking investing. I hope this video is something that you see value in. Understand the difference between saving and investing. Understand what a brokerage account is. Understand that it's just a shopping cart. And the market, the stock market, is where you go to buy the companies that make the products we use, buy, sell, resell, whatever, every day in and out in the hopes of earning more money. Understand that retirement money is treated different than investing money, and investing money is treated different than earned income, also known as your paycheck money. So if you understand all these different concepts, then I hope you're better positioned to start engaging in conversations online or with other people when you start talking about your finances. Folks, check out some of these other videos up here. Link to my channel, like and subscribe. I love my subscribers. And by all means, check out some of my other video content. I promise you'll find something profitable and or educational. I'm Paul. See you in the next video.